Today, the slow grind south, the DFA daily to the 23rd of March 2020. Hello again, it's Martin North from Digital Finance Analytics. Welcome to the latest post covering finance and problem news with a distinctively Australian flavour. And you'll see that I've renamed my daily updates simply the DFA Daily, because we're going to talk less about property for the next little while and much more about the broader financial markets, I think. And today it was very much a story of continued market falls and more bad news coming out of the woodwork, I'm afraid. So we'll go through some of the main highlights of today's events. And a good place to start is in New Zealand, where New Zealand started quantitative easing, and they announced that they would actually implement a $30 billion asset purchase of New Zealand government bonds. And they started off by saying that the severity of the impacts on the New Zealand economy has increased. Weaker global activity is affecting the economy through a range of channels, not just reduced trade. Domestic measures to reduce economic activity is impacting employment, and inflation is expected to fall relative to their targets in the near term. And the financial conditions have tightened necessarily in the past week, reducing the impact of the lower cash rate on achieving the MPC's mandate. In response, the committee has decided to implement an LSAP program of New Zealand government bonds. The program will purchase up to 30 billion New Zealand dollars of New Zealand government bonds across a range of maturities in the secondary market over the next 12 months. The program aims to provide further support to the economy, build confidence, and keep interest rates on government bonds low. The committee will monitor the effectiveness of the program and make adjustments and additions if needed. The low official cash rate, lower long-term interest rates, and the fiscal stimulus recently announced together provide considerable support to the economy through this challenging period. So once again, a central bank goes into the secondary markets, purchases bonds, and provides more liquidity back into the financial system. We've seen that playbook before, but not in New Zealand. So this marks another departure. And continuing to talk about New Zealand, the New Zealand Prime Minister announced severe restrictions will be imposed in the next 48 hours. They are at pains to underscore that essential services and banking services will continue to be available, but other businesses will need to close along with schools. So again, a similar pattern emerging here as elsewhere around the world. Meantime, over in the US, the $46 billion emergency supplemental funding proposal that the White House have submitted to Congress last week has ballooned to $242 billion in the Senate amidst frenzied negotiations, and lawmakers remain deadlocked on several key provisions. A summary of the supplemental spending legislation provided to stakeholders by the Senate Appropriations Committee says it will provide $75 billion to hospitals, $20 billion for veterans' health care, and a considerable amount for other medical needs. More than 75% of the $242 billion package, approximately $186 billion, will go to state and local governments, fulfilling a central democratic demand to bail out cash-strapped states such as New York. And the supplemental will also provide $20 billion to public transportation, emergency relief, $10 billion for airports, and $5 billion for the Federal Emergency Management Agency Disaster Relief Fund, according to the summary document. And the list goes on of all the other things they want to load in. So essentially this has got really complicated now, and the negotiations are certainly getting pretty slow, which is a worry, of course, because there are major issues in the US and measures do need to be taken. Now let's turn to Australia. There were a number of announcements today. For example, APRA has made some regulatory changes so that where a borrower who has been meeting their repayment obligations until recently, chooses to take up the offer not to make repayments, as part of the support package, the bank need not treat the period of the repayment holiday as a period of arrears. Similarly, loans that have been granted a repayment deferral as part of the support package need not be regarded as restricted. So it's giving the banks more latitude in terms of how they report the support that they're providing. APRA will be writing to all authorised deposit-taking institutions to advise them of the specific reporting treatment for loans subject to these support arrangements. But APRA will require ADIs to report to APRA and publicly disclose the nature and terms of any repayment deferrals and the volume of loans to which they are applied. ADIs must still continue to provision for these loans under relevant accounting standards. Now that's quite an important point. So we will get some read on the performance of the banks relative to how they are provisioning for these particular loans. And I just want to highlight the fact that yesterday, when the government announced their package, they did also mention that there'd be some changes in relation to bankruptcy and corporate governance rules, including the protection of directors responsible for companies who, under normal rules, would perhaps indicate that their business would not be viable. So we are seeing quite a move to detune some of the regulatory frameworks that exists currently to protect companies and to protect those who engage with companies. And again, this underscores again that we're living in uncertain times. And again, on that same theme, as reported in an Australian broker, the government relaxes responsible lending obligations. The government has announced a relaxing of responsible lending obligations as they pertain to business lending in order to ensure small businesses can access credit quickly and effectively in the coming month. As it stands, responsible lending obligations don't apply to lending predominantly for business purposes. However, in order for a loan to fall within this exclusion, a lender is required to undertake due diligence to confirm the money borrowed meets this test. Now, the government is changing this through providing an exemption from responsible lending obligations for a period of 6 months in relation to the credit lenders extended to their existing small business customers, so long as first, there is an existing borrowing relationship, and second, some proportion of that credit is used for business purposes. The exemption will apply to new credit, credit limit increases, and credit variations and restructures. The government recognises the environment for small business has changed and continues to evolve. The revision is intended to enable lenders to move quickly to support small businesses at a time when prompt action has become more crucial than ever. Credit providers regulated by APRA will remain subject to APRA's prudential standards while the exemption applies, and providers who subscribe to an industry code will remain obliged to abide to that code. So again, some easing of the rules, and for me, this question of how much of it relates to businesses will be a very interesting area to try and navigate. So for example, I get a loan, a proportion is business related, does that mean I get the whole loan without going through responsible lending analysis? We'll see. Now, in passing, let me just mention Harry Dent. I did a number of shows with him over the last couple of years. Harry, of course, is very strong on business cycles and economic cycles and was forecasting a financial crash at some point. I discussed this last year with him. You can watch that show where he says that the bubble has to burst. Well, it now sounds extremely prophetic, frankly. And in these uncertain times, of course, it's important to get as much information as possible. Now, Harry is going to run a web event, and his promoter asked if I'd be willing to share details of that event on the DFA channel. So I've done that. Now, I don't know what the content will be, and I'm not in any way being rewarded for mentioning this show, but Harry, I find always good value, and some of the observations that he makes I think are very pertinent given the current environment. So I'll put the link below if you want to get more information about Harry's upcoming web event. Now, continuing the discussion about regulatory changes, ASIC has recalibrated its regulatory priorities, as announced today. And essentially, they have put on the back burner a number of issues which were previously seen as high priority. And ASIC said that they're going to immediately suspend a number of near-term activities which are not time critical. These include consultation, regulatory reports and reviews, such as the ASIC report on executive remuneration, updated internal dispute resolutions guidance, and the consultation paper on managed discretionary accounts. Stakeholders will shortly be notified of deferred consultation and publications relevant to them. ASIC will also suspend its enhanced on-site supervisory work, such as the close and continuous monitoring program. In issuing information, gathering notices, ASIC has provided new guidance to their staff, mindful that many notice recipients may be facing significant disruption. By taking these actions, industry participants will be better placed to focus on their immediate priorities and the need of their customers at this time. Where warranted, relief or waivers from regulatory requirements will also be provided. This will include requirements on listed companies associated with secondary capital raising and audits, and ASIC has already indicated a take-no-action stance in relation to the timing of AGMs until the 31st of July and the conduct of AGMs by electronic means. And ASIC is also working with financial institutions to further accelerate the payment of outstanding remediation to customers. And finally, they say that ASIC will take account of the circumstances in which lenders acting reasonably are currently operating when administering the law. So this again gives a whole lot more flexibility to banks and other players. And this, I think, highlights that we are really, again, in uncertain territories and, in a way, unwinds some of the work that was done post the Banking Royal Commission. Now, the financial markets, of course, continue to gyrate. And a bit later in this post, we'll go through the latest prices. But there was a very interesting article from Bloomberg, because the financial crisis is now in full swing and credit markets are at the epicenter of current events, as owners of mortgage bonds and other asset-backed securities try to sell billions of dollars in assets amid reports that there are significant investor withdrawals from these funds. And Bloomberg reported that funds who buy up bonds of all kinds, from debt of America's largest corporations to securities backed by mortgages, have struggled with record investor withdrawals amid choppy trading conditions in fixed income markets. The rush to unload mortgage-backed securities signals that a credit meltdown that began with corporate bonds is spreading to other corners of the market. Further Federal Reserve support and other central bank support is being sought, which of course raises the question: who should be supporting who? And frankly, should financial speculators really be bailed out by anybody, let alone central banks? In a letter to the US Treasury Secretary Stephen Mnuchin and Federal Reserve Chairman Jerome Powell, the industry group in the US said the future path of what's happening has significantly disrupted the normal functioning of credit markets. And the group asked them to immediately enact a new version of the Term Asset-Backed Securities Loan Facility, a financial crisis-era program that helps support the issuance of securities backed by consumer and small business loans. Such a measure, the group said, would help enhance the liquidity and functioning of crucial credit markets. So the question here is just how far do you go? How many markets do you support? How much liquidity do you pour in? Is it completely bottomless, or should there be some limits and some priorities and some focus? And at the moment, everybody, wherever you look, is asking for help. And that includes the corporate sector. Industries were looking for direct bailout, as well as even those in the speculative financial sector. This is not looking good. And there was an interesting article on Wall Street. It's one of the sources that I turn to quite often. And it was titled Australia's Construction Industry on the Brink of Collapse. Australia's construction industry, which accounts for 13% of Australia's GDP and 1 in 10 jobs, is unsustainable and on the brink of collapse, according to Joe Barr, the CEO of John Holland, one of Australia's biggest infrastructure firms and a wholly owned subsidiary of China Communications Construction Company. "I won't quote it," he told the Australian Financial Review. "Tier 1 contractors in Australia are not making any money, and governments across Australia keep having successive project cost blowouts." The underlying message was not exactly subtle. Unless the government recognises the pressure the industry is under and allows construction companies to renegotiate contracts that are either behind schedule or beset with cost overruns, companies could begin dropping like flies. Bailouts, while not explicitly mentioned in the interview, may also be on the docket. That's a message that's being conveyed by captains of all kinds of industry in all kinds of countries since financial crisis 2 began. As the economy freezes, companies suddenly see their revenues and earnings drop precipitously. Out of force of habit, they then ask the government to make up the difference. And I think that is actually the critical point. Just how far do you go with government support and government bailouts for industry? Now, my own perspective is that we should be focusing more directly on supporting households and small businesses rather than supporting the big end of town, who frankly should be big enough to look after themselves. And yet, those with muscle and those with voice, for example, the transportation sector, the construction sector, and the financial services sector, will probably get the ear of government much more easily than people talking on behalf of the average Australian and the average small business owner. And it worries me that the last stimulus package that we discussed yesterday, link above, actually makes it more difficult insofar that money is being handed to firms to be passed on to employees to keep them on their books, but there is no legal basis under which that money which is being passed to businesses will necessarily follow through into the pockets of employees. And worse still, because of the way it's being implemented, the employees with the largest incomes are more likely to be helped than the ones with lower incomes because of the relative tax breaks that are being provided. So I'm afraid that, to my mind, we are looking in the wrong place to provide the wrong sort of help to the wrong sort of businesses at the moment. And we better get that act together soon, because otherwise it will be too late. And finally, in today's review of events, I just want to highlight this little gem. I highlighted the post on the DFA blog the day of the hybrid, because last week NAB announced that they were to withdraw a capital issue due to market conditions. Today they announced the conversion of 7.5 million NAB capital notes, which were issued on the 23rd of March 2015, and they issued 35.1 million fully paid ordinary shares in connection with the conversion at a price of 21.34. Now, those original securities, which were hybrid securities, in other words, those could be converted at some point into shares, were paying 3.5% plus bank bill rates less the tax rate. So that was quite expensive relative to other funding mechanisms. They are also due for conversion no later than the 23rd of March 2022, but there was an option to be converted on the 23rd of March 2020, which NAB exercised. Now, I see that some were claiming this is a sign of distress at NAB, but I disagree. This is a convenient and effective method of enhancing capital ahead of pressures ahead. Yes, it's a conversion, but frankly, tagging it as a bail-in is, in my view, inaccurate. This is an exercising of an option. The share price of the conversion, of course, was much higher than the market price. Market price is currently around 14.22 relative to the conversion price of 21.34. So somebody out there in the investment land is taking a bath, but not NAB. And so NAB now has more ordinary shares. It's worth noting also that the NAB share price fell more than 10% today, simply because of the downturn in the market, not particularly because of this particular event. So it's very important, I think, in the current environment not to jump at every shadow and, frankly, put out information which is not completely true. This may, on one hand, in one way, be described as a bail-in, but really no. This is just a normal option conversion and has no signal at all with regard to NAB's financial status. And now, before we close, a quick look at the local market. The ASX 200 was down 5.62% to 4,546 on another down day. The financials index was down 10.22% to 3,658. The real estate trusts were down 11.21% to 877.40. And the volatility index eased back, down 17.09% to 36.71. And the ASX 200 futures is down 3.75% to 4,535, signalling probably weakness in the US, but also concerns ahead in Australia. Amongst the banks, ANZ was down 9.66% to 14.40. CBA was down 7.35% to 55.50. NAB was down 9.88 to 14.22. And Westpac was down 10.22% to 14.23. The Bank of Queensland was down 12.77% to 4.85. Bendigo was down 12.09% to 5.67. And Suncorp was down 5.45 to 7.81. And Macquarie was down 13.25% to 74.06. AMP was down 13.74% to 1.13. Lenders Mortgage Insurer Genworth was down 14.86% to 138. McGrath Real Estate was down 11.11 to 0.16. And by the way, he came out with a comment today along the lines that property, in his view, was a safe haven. Well, good luck with that. Yellow Brick Road was down 14.49% to 5.9 cents. And AFG was down 21.16 to 95 cents. Mortgage Choice was down 12.9% to 54 cents. And CMAC, the Building Infrastructure Group, was up 6.87% to $21. The Aussie US dollar rate was up 0.17% to 58.08. The Euro Aussie dollar was up 0.6% to 1.8543. The 2-year Aussie bond was down 5% to 0.285. And the 10-year bond was down 0.27% to 0.920. The gold Aussie cross was down 0.48 to 2,568. And the Bitcoin Aussie cross was down 6.9% to 10,257. And looking towards what may happen in the US tonight, the S&P 500 futures is down 3.67% to 2,204. And the Nasdaq 100 futures is down 3.07% to 6,756. Now, if indeed that large package of measures which is being discussed on the Hill in Washington is passed, we might see the markets turning up. But on the other hand, the news from the US continues to be pretty concerning, particularly down the West Coast and also in and around New York. So as this situation continues to develop, I think we're going to continue to see weaker markets for some time to come. It's interesting that a few days ago there were a number of prospective investors talking about buying the dip. Well, my perspective is this: the dip is going to continue to dip further, and you do much better to stand on the sidelines until things actually turn around a little. We're going to see more downside on the numbers ahead. And I also want to make the point about the fact that we should be quite cautious about the state of, for example, the banking system and the financial system more generally, and go with the data, not with the speculation. Because if you clicked on some of the YouTube commentaries around the place at the moment, well, some of them are really to the point. I think they've gone over the top and are forecasting gloom and doom even beyond what we think. But that said, the chances are we are going to see a recession. We could well see a depression, and we could see deflation as well. But of course, that all depends on what happens with regard to the health issues and how quickly this turns around, if it does, or whether in fact more of the economy is put into free fall simply because economic activity has to be turned off. The next few days will be very important, and we'll be back tomorrow with the next update. And just before I go, let me just say that you will have seen that I've gone a bit net with my production values at the moment, and that is because there is so much information to get across, and I want to spend more time analysing and presenting the information to you compared with editing the videos and making them look really flash. So we've done away with some of the videos, we've done away with some of the flashy editing transitions, so you'll be getting basic data presented relatively straightforwardly from me over the next few days. I hope you appreciate that change of style, but given the situation, I felt that was best. And these will be entitled DFA Dailies. Simple, straightforward, and hopefully to the point. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.